The floor is yours.
Okay.
Hello,
Cheryl?
everyone. Oh, excuse me. Let me just see. I'm going to let everyone in. Thank you for joining. For those who are already here, can hear us. We'll just let everyone in very slowly.
Hello.
Hello, welcome everyone. Thank you for joining us. We're very pleased to have you here today. My name is Cheryl Morisseau, and I'm one of the program managers of the MSIE program. I have here with me today Professor Etienne Krieger and Susie Meyer. And today we are very happy to present you the topic of new venture financing. So Etienne, please, over to you.
Many thanks, Cheryl. It's always a pleasure to co-host these webinars with you, and today with Susie, who is zooming from Switzerland. We had a few snow in Paris a few days ago, but it has melted soon, and now it's just muddy. And so I'm very jealous of your environment, Susie. But anyway, that's not the topic of today. So again, thank you, Cheryl and Adrien, who also helps us to run this conference. And the topic of today is about new venture financing and what conveys trust. Some of you probably know that I'm obsessed by this notion of trust because I even made a PhD on that. What convinces an investor like Susie to make this leap of faith? And so let's just share a few slides. But of course, this will not be a course, a new venture financing course, but it will more be a discussion, and I will soon leave the floor to Susie. So a few words of introduction, and so 25 minutes experience sharing, and hopefully some Q&As, even if Zoom is not as interactive, but it does the job. And so if you have some questions to Susie, it's the moment to use the discussion thread or to intervene directly. So I'm an HEC professor. I'm doing lots of things. I'm an Excel addict and many other things. But I think it's more interesting to know about Susie's background, except that she also intervenes in HEC's juries, in the final pitches. She's harsh but benevolent, and I really appreciate to work with her. So Susie, what about your life and your job?
That was probably the nicest introduction in the world, Etienne. So thanks a lot for that. And indeed, it's such a pleasure, honestly, every time we get together and work on some interesting topics. So obviously this one seems particularly exciting. I'm currently working for a UK fund called Notion Capital, and we are a Series A stage fund, which means we typically invest sort of in the earlier side of businesses. And in terms of numbers, that's sort of between somewhat 2 to 10 million in check size. So every round that can go up to 50, 40, somewhere around that sort of bar we would play a significant part in, and we come in as minority investor, classic VC structure. So in terms of preference, what I like are companies that have a very specific need, as in the product is very sophisticated. And secondly, usually the team comes out of, a strong background, and there can be either work experience or a really reputable business school, like I should say. So I think that's where the ties come together. Now, in terms of things that I personally like, it's B2B SaaS software, and then we go all the way down to fintech insurance. It's quite tailored, quite niche, but I'm happy to just expand a little bit beyond that and talk about whatever is on your mind, if it's a marketplace, if it's e-commerce. So there's quite a broad range, I guess, of early stage companies today, even including deep tech. So, whatever you guys feel like you have any questions about, let's do that. So I guess the following pages we've put together, Etienne and I. And so I think he's going to kick off a little bit with a couple of general research pages on trust.
Yeah, some general thoughts. on trust, but just to make the link, why trust? Because so you are intervening in what is called private equity and the very early stages of private equity, capital investissement, which is seed and venture capital, whereas there is a bit more money in leverage buyouts, and where their deals are very structured, and we could very data driven, and contracts are much more important. Whereas at early stage investment, of course, there are shareholder agreements, but it's a leap of faith. And as most VCs say, 75% of the investment decision is linked to the team, and so to this famous trust. And so that leads us back to an assessment on the competence and the nature of intents. So a technical component, and another one which is a bit more difficult to assess, which is a moral one. And how do you check this in order to create fast trust, or to see if there are trust killers? And so again, the whole management tends to try to evacuate trust from business relations, because it's too risky, because it may be interpreted as laziness or incompetence, and that led Oliver Williamson a few years ago to write an article to say that trust only muddies the clear waters of calculativeness. And of course, I disagreed with that, and I tried to see if there is something in business relations which remains linked to trust. And of course, it is. So you have some testimonials about from business angels and early stage VCs, where you see that they have different strategies to invest, but there is a component of fit, of liking, of sharing something, and that's not only encrypted in a 50 pages shareholder agreement where everything is defined. And even entrepreneurs who became themselves VCs, like Pierre Kosciusko-Morizet, who created a famous platform called Price Minister, which was exited for 200 million euros to Rakuten Group, says, okay, we have to share something, but trust, but verify, we check, we do our due diligences. And so there are some obvious trust facilitators, and some trust killers, some inhibitors, and all these quick introduction to leave the floor to Susie, and to say what makes a good deal, what makes a good pitch, and what destroys rapidly trust, because you probably see hundreds of deals, of business plans, and you have to decide fast and to be in competition with other funds for the best deals. And how do you create trust also to be selected by the best entrepreneurs, and to create this partnership in order to exit? So can you explain what's behind the processes of venture capital?
I mean, there's a lot of different nuances around trust, right? So as you already mentioned, there's the relationship between the fund, as in the investor and ourselves, and the entrepreneur. Then there's obviously the level of trust between what they tell you, what they actually believe in, and where maybe a little bit of optimism kicks in. So there's a lot of level of trust in themselves. Then there's the level of trust within the fund. So as in, just because I tell my partner I really want to do a certain deal, he also needs to have the trust that I did the right due diligence. And then obviously lastly, there's the ongoing, next 10-year life cycle, where we have to trust each other that we're actually on the right foot and we actually want to reach the same goals. So there's a whole level of different areas of trust, if that makes sense. And so the one question I keep hearing in these days is around, how do you create trust in this unprecedented environment around COVID, where you can't meet people, you can't see them, you don't have those non-verbal communication impacts? So I guess that's why I wanted to start with this page in particular, because obviously COVID has presented us these challenges, and for a lot of people it has been more challenging than before to really create those strong bonds when you can't meet people for a drink and just get to know them, but you actually have to see like a lot more things a bit more nuanced way. So I put a couple of thoughts here on paper, but happy to expand on each of them. So the first one, obviously, we need to try to stay focused on the opportunities this whole situation can bring, and I think one of them we've seen all over the press is how the paradigm shift has happened in technology curve between the late adopters to the early adopters and how to shift now forward. So there's been a lot of more accelerating times, I guess, in many ways. So the key here and the advice I would give is to be flexible and open to think about pivoting maybe. So for example, if you had a product that was mostly a pure consumer product you would sell in a shop, the shop is closed now, what can I do? So where do you see sort of the flexibility and agility come in? And so how do you move this then into maybe another geography, into another market, into another product range, another offering? So there's a lot of different ways you can sort of take what you have and just put it to a level that can function and work in these environments. The third one is if you can spot an opportunity, don't waste time. So if you feel like there is something shifting in the market and you almost feel like, okay, it's not offline, it has to be online, or I used to sell to large banks and now it's the neobanks. So there's a lot of things that you can just move around. But if you spot the trend, don't waste time, because guess what? Everyone else will start to think about the similar lines. So you really want to be at the first to execute on those things. So execute today. Fourth, inner strength. I mean, we've all probably been struggling to some degrees with the current situation and a lot of things happening around us. It's really hard to concentrate, but it's more important than ever now to just put your head down, think about applicable irrespective of the maturity level. So wherever you are in the life cycle of the company, just try to focus on exactly the next couple of steps you need to take either way. So no one's going to help you accelerate, and inner strength really matters a lot right now. And the last one, stay true to your values. So it's a really high level phrase, and I've completely appreciated people say that's too vague. But I guess the key really is to understand that how you behave right now, this will be remembered. So under pressure, people sometimes show the best and the worst faces. So a couple of people, for example, a couple of founders I spoke to about a year ago seemed, perfectly backable. And then today, because they've been under a lot of pressure, you can almost see a different side to them. And I guess it's really important for you and your team and your employees and your, all the other stakeholders around you that you stay true to being a good leader and show your true self and not try to, let this whole mess impact how you act around people that, make important decisions around you. So I guess that was the key piece around COVID, and that now let's push that aside because I think there's a lot more important things in general than this current wave, but I think I just want to get it out of the way. Now, this next big piece what makes a great pitch? So when is a pitch actually good and what is convincing? And what should you do? What should you not do? I think that's really where we're heading. Now, I started with the positives. So here are the things that I would love for every founder who comes for a pitch to do. First of all, please do your research. Ensure that you focus only on people who are really active in your space and sector. You would be surprised how many times, as a B2B SaaS investor, I have a very specific mandate, but I get approached by completely different people, different stages of environment. Like, it's really important that you approach the right people. Otherwise, you're going to waste so much time along the way and you keep repeating the same pitch, but it's not going to stick because you're just talking to the wrong people. Now, the next piece is you need to be able to really explain what the product can do in a few words, in very simple, high level, few words. And this is super, super important. There are people that are incredibly creative and visionaries, and they can talk for hours about the product and no one gets it. So if you really want to make a lasting impression, you need to be able to tell me exactly what your product can do in a very crystal crisp way. Next one. Go the extra mile and show me a brief product demo. You'd be surprised how many wonders this can be. So if you pick someone up right at the beginning of a conversation and you just tell them, look, here is the demo, here's the product that we published, that we're in beta, alpha, whichever version you are, it picks people up and it gives you a really good chance to actually have a dialogue and a conversation about the product and what you're trying to build. And also check if the other party understands what you're doing, because more often than not, it's not a one-way street, right? If I don't get it, maybe you also feel misunderstood and you don't even want to work with me. So it's really important that I'm always calling it not a one-way street conversation, but it's a two-way. It's not a monologue, it's a conversation. So a good pitch really needs to show product, explain it, be able to tie things together, and then actually have a conversation about it. Number 4. Be clear how much and what you will do with the funding. It is the key reason you're talking to me in the first place, right? I'm not a potential customer. I am not offering you a partnership. All I'm offering you is here's some sort of money and some operational help along the way. Now, if you cannot explain to me what you're going to do with this money, it's going to leave me with a lot of question marks, right? And a lot of people say, I want to raise a 10 million round, and they cannot explain why they want to have 10 million. Maybe they only need 5, maybe they actually need 15. It almost doesn't matter how much you need, but I need to understand how you're going to spend it and why you raise as much. The last one, always follow up. So when we agree on a call on the next steps, as in, please, now, can you send me the deck? Can you send me a link to a product demo? Can you do that? Make sure you do that. It is so often that people just take call after call after call, and they think that the more calls they take and the more people they talk to, the more momentum they create. I think the truth is the other way around. The more meaningful conversations can be, and the better you follow up, the better your results going to look. It's quite an easy, mathematical equation. The last one, and I put it in red, be friendly and positive. There is nothing more annoying than having to talk to 50 people a day and everyone is negative, pessimistic, and quite unfriendly. So if you actually want to have an engagement and make me, feel like I want to take a second call, please just, show a good attitude. And I guess the way we look at things is it's going to be an 8 to 10 year marriage, right? We're going to be in this for the long run. So what I really want is a nice guy and not a grumpy cat. So it's all about, do we get along on a personal level? Are we really able to talk about business in all its varieties, all its different colors? And can we talk about strategy for the next 10 years and really realize how much we can work on something together? And can we function as a good team? So the really difficult part, I think, right now, and going back to COVID, is everyone has so many negative things happening that it's quite easy to start a call with a negative note. But that doesn't usually work. I think the truth is, if someone comes in the room and he just keeps going on about, oh, we lost 5 customers this year because this happened and we didn't quite get the product we wanted, and they tell me all those negative things, I just don't feel like I really want to be part of the journey. Rather, if you tell me, look, we had 3 customers churn, but actually we won another one, and that's a big highlight for us. So something positive about it, it's going to make the discussion a lot better. And with this, I guess we're moving on to the ones, the next page.
So be professional and positive thinking and not being a grumpy cat. I have lots of questions at this stage, but let's continue with this metaphor of an 8-year marriage.
But I think that's the way it is, right? I mean, this is going to be a long-term partnership to many levels, and you really want to make sure that you're not going to fall out after 6 months. So there is a bit of a stress testing as well. Now, here are some of the deal breakers that we put together. And I think this page is really important to see the green and the red. So the green are obviously things that you should be doing, but if you don't, they're deal breakers. And the red ones are things that please don't do at all. So let's start in the green ones. And you'd be surprised if you make the same mistake. So I'm just going to go very slowly through those points because they keep coming up. So on the green ones, present the company in a very clear, comprehensive, and accurate way. And intonation is accurate. It doesn't matter where you are at the stage. You don't have to lie about it. If the product is still in alpha or not in beta, if the team is not quite as full as you want it to be, it sometimes matters so much less than just having the feeling, and that goes back to trust, that you're telling me the truth. So I want to see accurate information, and I want to see consistency, which is also a word that Etienne pointed out earlier on the map. There was a word around consistency, giving the same message and being clear what you want to do. And it's going to help people to really feel confident about what you're doing. Next one. Talk about the rest of the team as well. Like, usually a lot of teams are not a one-man show. Just because you're the one on the call right now, don't forget the rest of the team. So what I really want to see is, who are you as a group? What are the strengths? Where are the weaknesses? How does the team work together? If you only talk about yourself, you're almost cutting out a really important element to your pitch that is actually really vital when you think about the different puzzle pieces and how they come together. So it's not just about yourself in this call. Make sure you mention at least who else is working on this idea, on this vision with you. This can be a member of the team, this can be a management member, this can be an advisor, it can be an observer, it can be an angel. It doesn't matter, but give me a background of who you are as a team. Next one, I capitalize because it's really crucial as well. Know your numbers. There's nothing more confusing than someone who's running a company and he doesn't know very basic numbers. I'm not talking about decimal points. I'm not talking about, 5 layers down the P&L. I'm talking about the basic numbers, but they need to be here. It's very confusing if you talk to someone and he cannot tell you how much money they made last month. It is just, it doesn't give a good level of trust. And I guess we always come back to the trust point here, which is, a bit of an irony. So a founder who doesn't know the key numbers for business is just not credible. And this is the truth. I really want to see that you have the operational leverage, you have the operational skills, and you know exactly how to run a business, and you know exactly where the business is today. So things like cash burn, how much money are you spending each month? It is very simple. And you can look literally at the account at the end of the month and just see a number, but have a feel for what is in that number and how it comes together, and be able to explain it, and also how it's going to look going forward. And the same is true for the other side, the revenue side. How many customers do you have? How much does each one give you a month? Here we go. So it should make sense really, really quickly. And if it doesn't help with the trust. Fourth, be open to questions and try to answer them in simple terms. So as you keep seeing, I use the word simple, not because I'm a simple person, but because I like simple expressions. And if you can explain things in simple terms, it's going to stick with people a lot more than overly complicating it. Opening to question means I'm doing to you a monologue right now, but I guess the truth is, in a perfect pitch, this would be a really good conversation where you're telling me something, I'm just clarifying something quickly, a question here, or we're going to go off track a little bit and we don't stick to like a protocol, because otherwise you can just send me the deck and I can read it on my own terms, right? But what I really want to do is you tell me something and then we start having a conversation. Last one. Have a good answer for what are you looking for in an investor? Because as I said earlier, this is really also about you finding a fit. So it's not just about me telling you yes or no. It's really also about us seeing, can we work together? So what are you looking for? Maybe you're looking for someone to help you expand in the US. Maybe you're looking for someone to help you create a new product line or refine your business model. There can be all kinds of different things that you might want to have help with. But it's really important that you know exactly what you're looking for before you just stumble into something and then you're potentially stuck with the wrong person. So also think about, what exactly do I need? Be able to articulate it and tell me, look, I really need help to expand into the US. Guess what? We can do that. But I think there's a lot of other funds who might not be able to do this. Just as like, if you want help with Asia, I cannot help you. So I think people are going to be very honest about their own capabilities. If you know exactly what you're looking for, it's just going to make it a little easy for yourself. And the last one, how will you spend the money? We already touched upon, but it's really important to remember how exactly are the next 5 steps going to look like? How long is the money going to last? And what exactly are you going to do and achieve with it? So let's talk about the red ones. It's horrible when people talk without a break or pause, right? So we've all been in lectures or in sessions where people just kept going on and on in a monologue, monotonous voice forever. And you just feel like they're losing you halfway through. They don't smile, they don't change the voice at all, they don't give you anything novel, they don't make a little joke. So if you talk without a break or pause, you're going to lose me. It's so true. And I think a lot of people feel probably the same, right? A good pitch is never just rehearsed. And here's the intention of rehearsed. I know that people get really scared about public speaking, and that is okay. And sometimes, especially when we're not fluent, it's easier if you just read a little bit what we wrote down. There's nothing wrong with it, but if it sounds rehearsed, it doesn't feel good, right? So it's a quite easy way to think about, again, a conversation. So don't rehearse it. Practice a little bit, but don't rehearse word by word. Next, tell the investor about other people you're speaking to and which valuations they have indicated. Now, that's a sensitive one, because I guess in a way you want to look like you have a lot of interest and your product is so good and so exciting to a lot of people that everyone's reaching out. And it might feel like a lot of people are reaching out because you get all these LinkedIn requests to speak to you. And as soon as you got put into Crunchbase or some sort of a news article, people will start reaching out. However, that doesn't mean that you should play them against each other. You see what I mean? So there's a bit of a fine line. It's great when you feel like someone can see value in what you're building, and that is phenomenal. And I can't even describe the feeling one must feel when you feel like, oh man, the idea I had, it's taking up shape and people show interest. That's phenomenal, no doubt. But what you don't want to do is tell me, by the way, I'm also speaking to episode 1 and to Dawn and to all these people, and they have told me they're going to put this amount of money at this price. Where are you? That doesn't work. So you really want to keep it a bit higher level. Focus on the conversations you're having one-on-one. and not play too highball if you don't have to. Try to outsmart us by telling us what you think they want to hear. So as in, you might think I'm a Series A investor, so all the things that I'm looking for a Series A round are X amount of revenue, or maybe it's, you know, a product that has at least 3 different features. And so you're telling me what I want to hear, but the truth might be something really different. Now, what's going to happen is that I'm going to remember these things to a certain degree, not everything, right? But hopefully the majority of what you're saying, I'm going to take notes, I'm going to remember. And so if you then speak to someone else and you tailor your messaging again, and I talk to this investor, we're going to realize there's a lot of issues going on here where we were being told very different truths. And this is how you create the biggest issue around trust. If you spread inaccurate data just because you think you're smarter and you can just tailor things and storylines as you please, and if it comes out, I mean, it doesn't always come out, but I guess chances are it might be, it's really going to hurt you. So just avoid it altogether. Keep it clean. Here's the story. Maybe you tell me you're really early and I can tell you, well, I know another investor who's earlier stage and he might be right for you. So there can be a lot of good things coming out of just being very transparent. Last one, absolute no-go is sending nasty messages. So the amount of people that, you know, we speak to on a daily basis, and unfortunately, just for whatever reason, it doesn't fit our thesis. For example, it's a bit too early, it's a bit too late. There's 100 reasons why I might have to decline a company, even though it might be fantastic. All right. So a decline doesn't necessarily mean I don't believe in what you're doing, or I can't see you being an exceptional founder. It's more like it doesn't fit our model, or it's the business model that doesn't work, or maybe it's the geography, or there can be so many different pieces around it that it's really important not to piss people off by sending them a nasty email. The key reason for declines is usually not to believe in you. So don't take it personal. It's more that it doesn't fit whatever strategy we're running. So for example, you know, travel right now is obviously not a very solid sector, shall we say? And I think a lot of funds have now shifted away from investing in travel. It doesn't mean that your product cannot work. It just means that right now might not be the right timing for a certain fund or another, right? So that's the sort of bigger message I want to give you. And the last one again in red, which is really, really important, the world is very small and everyone knows each other. So not me personally, but I think, you know, through 1 or 2 links, we pretty much know everyone in this industry. So, you know, there's a lot of conversations happening maybe that you don't necessarily see. So you should really make sure that you don't ruin anything at all by just sending a message that is not needed at this stage. Keep it nice, keep professional, and try to understand feedback, because a lot of times it is other things, as in, I don't believe you. And so these were the deal breakers. And now moving on to the next page. Right, so this is beyond the pitch now. So you've had a successful conversation with someone. You really found like there's a lot of commonalities. This is the person you might feel like, yeah, you would like to have them on the board for the next 10 years in your marriage. Now, what do? You have to remember, successful companies are the basis for successful deals, right? So there is no deal without there being a company. And I think a lot of people are very, very focused from the ego perspective, from a lot of different facets around how can I create 5 million funding? It would mean the world to me from an ego level. The truth is, it's not going to happen without a great company to begin with. So I put here 7 key puzzle pieces together that include the team, the product, the market, the ICP, which is the ideal customer profile / go-to-market GTM, the traction, the exit, and ultimately a deal. As you can see, the deal comes at the very end, because only if all the other pieces fall into place, we will get to a deal, if that makes sense. So a couple of points below. Focus on building the company first before you even start to pitch. There are people, I think, who come up with a really interesting idea, and then they go around and they tell everyone what they're going to do, and they ask for money. And this can work in Silicon Valley, where things are a little bit more, how do you say this best? They have just a very different style. I think in Europe, we're still at the level where we just want to see a little bit of traction first, a little bit of more, you know, product development, company development, etc., before we just jump into something. So first focus on building the company, and then we can talk about it. If you're able to compile a great team, build a great product, find the right niche in the market, and develop a really good go-to-market strategy, then everything else will follow. And this is crucial to understand. You cannot start thinking about the exit before you have built the team, found, the product, etc. So it's important to remember the order of things. Don't tell VCs about things that you don't have right now. Tell them what you do have and where you could use help. It's about the wording. It is super important that we don't start about, oh, well, right now I don't have the team yet. I don't have the product yet. Okay, fine. But tell me, we have a little version of the product. What I really want to do is build another 20 features around it. It sounds so much better. It just sounds so much more like you're actually building something rather than, oh, don't have this, don't have that, but whatever. No. I don't have all the pieces today, but I know exactly which ones are missing. I know exactly the strategy, the roadmap. I know which product I want to do first, which feature comes second, how the API are going to look. The more you can give shape to the vision and the product, the more likely people are going to buy into it, right? Otherwise, it's just going to be like a vague, correct? And you're going to lose people along the way. Last, don't get discouraged if the first VC is not the right one. Keep dating until it's the ideal match. So I guess it's anonymity to dating, because I guess in the real world, it's very much the same, right? We're going to have a chat. We're going to see if we get along. If we do get along, we'll have another chat. And, at some point you realize actually the person I was in a call with, we didn't really click. He didn't really get the idea. He didn't really buy into what I'm trying to do. He didn't really support me. He promised me all these things, but actually it seems like they don't have these capabilities that he promised me to have. So let's cut the discussion short. I'm not going to settle for the first VC that I'm going to speak to, because actually I believe they're not the right partner. And it's so important to remember this little analogy. On the other hand, sometimes, you meet someone, a founder, and I'm telling him, look, I really love what you're doing, but you're a bit too early for me. Maybe we can catch up in 6 months. Timing is everything. So if you can't get together today, well, maybe there's a future chance, right? But it's really important to maintain these open dialogues really early on. Otherwise, you're going to end up with the wrong partner. And I think that's sort of key story here about successful deals. So we move on to the next one. Oh yeah, here we go. Now back to Etienne. Not sure he wants to go into those pieces.
I think we better move to the questions and answers, because that's a series of best practices. But again, thank you so much for this testimony, because this trust has to be reciprocal. And so there was a first question from JP, Jean-Pierre, Jean-Paul, Jean-Patrick, I don't know, Bailey. A couple of questions. What are the best ways to connect with VC? Being introduced by someone of trust. Can you do it, or do you accept cold calls, or do you prefer fundraisers, investment banks? Again, at A stage, seed or A stage, yeah.
Got it. So there's a couple of different avenues, right, that people take. So there is obviously things like today where we see each other maybe through a quick Zoom call. There's a lot of people, I'm going to put you my email address after, and people reach out. So that's a very common way for people to just get in touch. Obviously, there's a big one called LinkedIn. I don't know how many messages every day go through LinkedIn, and they usually say something like, my name is X, I'm building company Y. Here is currently where we are, 5 bullet points. Keep it short, simple, and here's my email address. And we'll get in touch. I mean, honestly, I swear to you, I always respond to every single one. Most of them are going to be like, actually, it sounds like you're not B2B SaaS, so I can't really do much for it. Maybe it's really interesting and I can put into something else. I'm trying to really respond as good as possible, but it's a very common channel for people to just get in touch. There's obviously conferences. So I don't know how many conferences you attend, because these days they're not very exciting, I guess, but there's SaaS Stock, for example, for me personally, it's really important. There's Web Summit, you have South Summit, there's 100 different places. Also in Paris, obviously you have, I should say, what's it called? B2B Rocks. So there's a couple of big conferences out there where they're little booths and you can meet people, exchange a quick email. Don't overdo it. I think that's really important in those first little intro paragraphs. Keep it short and sweet. Just tell me where you are. So key things to remember. What exactly are you building? What's the business model? Because if it's B2C, B2B, it makes a huge difference. I want to know which kind of like a revenue model do you have? So as in, do you do subscription? Do you do a marketplace commission fee? Which kind of model is the underlying one? So really talking about the business structure. also how much you're trying to raise, and ideally from which kind of investor. So if you can put those couple of bullet points in the first approach, you're going to get a lot easier response rate, because you I can go through my little checkbox in my mind and just make up my mind if it could be a fit or not. Now, the next best way is obviously through friends. So whenever you have someone that works in the industry and he can recommend you, it does help a little bit with trust. Because the truth is, there are cold inbounds, and I really try to take them as serious as I can, because there's amazing people out there and I probably would never come across them through a friend. So I need to just really look at every single one by one. But if it comes through a recommendation, it typically comes with a slightly warmer feel to it, right? Because for whatever reason you believe, like, the person wouldn't have introduced you if he didn't also believe in it. So there's almost like a second pillar of reference. And then I think a couple of weeks ago, I gave a workshop around how VCs sort of work together across the different stages. And in that case, if a seed fund sees a company, it's too late for them, but it will be in our stage. We pass a lot of things on among ourselves. So it doesn't always have to go through your own effort, but it almost goes viral by just like you being in the right place, but not quite. So we can easily help you out a little bit along the different stages as well. So warm intros are always really welcome. But equally, I think all the cold ones are good too, as long as they don't look like spam. And I'm saying this because some people write pages and pages and pages and pages about their thesis and their model. And trust me, we don't have time to read it. Like, it needs to be to the point, very precise, very clear, and then you're going to get an answer. So I hope that clarified the question a little bit.
I think one of your colleagues analyzes 5,000 business plans every year, and so they only made about 20 investments. And so again, you have to go to the point. And so it can be cold calls, but stick to the point, or it can be referrals, which activates what I call partial transitivity of trust. If I tell Susie that, or tell somebody to contact Susie on behalf of me, if it's a good contact, it will enhance trust that Susie will have in me. And so I will only give her good contacts. Otherwise, it will destroy the trust. So JP's second question was, are there fields of specialization and geographical competencies in VCs? Or are there some generalist funds that invest in everything, deep tech, fintech, biotech? What are your thoughts about that?
There are as many as you can possibly think of. So obviously there are funds that are only, let's say, a seed fund in Paris would only invest in maybe local businesses. Maybe you have a large, series A, B, C, D, E, all the way down the alphabet in Paris who can do global. So there's everything on a global scale that you might think about. I guess there's a lot of controversy around the UK right now, with a lot of British funds investing in mainland Europe around, do you have a Euro fund or a pound fund? What can you actually do? How much money needs to be deployed in which region? So there's a little bit of geographic, scramble going on behind the scenes, but the more important one is the stage. So is it actually seed, series A, series B? Because it sounds also similar, but it's so different. Like, a company at seed stage has very different dynamics, has a very different DNA than a later stage one. So it's kind of important that you hit the right level. In the very early stages, obviously the angels that you might have one on the board, they can easily help you with the seed funds. The seed funds then sort of pass you on to the right series A. You almost go through a certain ladder of different parties. And so a lot of funds are quite specialized on one of those stages, and a few ones can do the whole range as well. So it's not necessarily a good or bad thing. It's just whatever people feel like they are most confident in, and they have the most experience as well. The last one is there are obviously then sort of sector differentiations. As you pointed out, there's fintech, there's deep tech, then there's very specialized B2B SaaS fintech. I mean, we can go as granular as you want. And equally, if you think about the big ones like Index, they do everything from consumer to US deals, Asia deals, like they're all over the place, and they do a lot of different things. And so they can be a lot more flexible, I guess, in terms of business model. Whereas if you, look at us on the other side, we only do B2B SaaS, and then we only go fintech. So there's a lot of different layers, and every single fund has like a lot of those things, which is why I said earlier, it is so important to really understand which funds it's exact. And it's really hard outside in, I get that, but it's really important to understand who does what. Otherwise, you're going to be wasting your time a lot, and a lot of no's are going to come in declines because it was just not a fit for the strategy. So Etienne, you might remember we had Audrey and I think I talked about her a little bit. So she's at a US fund, and what they do is very specialized med tech. So it's a super, super small little niche in the US. So not only medtech, but actually within medtech, only subscription medtech, and within the subscription, only the one that is for the hospitals. So you can go as granular as you want. Equally, they sit next to Excel in the US, who can do pretty much everything as well. So it didn't really answer the question, I guess, but the important thing is to remember it goes by geography, by stage, and by sector. These are the three key pillars.
Mm-hmm.
You did answer the question. Thank you.
Okay, thanks. And so if we focus on seed, venture, and perhaps growth, there is another very interesting question from Ndiaye Umar. When to decide to explore VC? So of course, if you create a biotech company, you cannot start without money. But I know some companies that start, they are bootstrapped, and then they want to accelerate. So when is it ideal to contact a VC?
Oh, probably the hardest question one can ask, because it's so personal, and every single founder has such a different journey. So it's really hard to generalize. But I think if you start a company today, right, there's a lot of different routes you can take. So for example, you can apply for a grant from a school you attend, or you can apply for a UK or a EU or whichever sort of local governmental scheme there are for really interesting ideas out of uni. Or there are certain, accelerators, incubators. Think about EF, which is Entrepreneur First, that are really trying to put also teams together. So there's a lot of early things that can happen. You don't necessarily need to go VC straight away, because it tends to be a little bit down the line. So usually people are bootstrapping, as you mentioned, or bootstrapping, by the way, means that they fund the business with their own money for the first couple of months, weeks, however long it lasts. And then they find a grant, they find maybe a board observer who's willing to put a little angel check in. So there's a lot of different ways you can structure the early beginnings. But what people really want to see is how efficient you are with this capital, right? So if you're burning 500K and you still don't have a product, that's a bit concerning. So what I really want to see is that you're using this little money that you get along the way in the most efficient way. Now, typically, the trade-off you're going to be doing as soon as you approach VCs is that obviously your stake will be diluted. So the little math Excel calculation you need to do for yourself, and I'm putting the ball in your court here, not in mine, as you can tell, is the calculation you need to do is, if I raise X amount, how much am I get diluted? And is this really enough to accelerate more than I would have without it? I can say it again because it's not that straightforward. But essentially what you're doing is you're taking on this money to be quicker than how fast you would have been without it, by just like selling one customer a year or two. Now you want to do 20. So you need a lot more cash, correct? But you could have gone quite a long way without ever raising any VC money. So it's really about yourself and trying to understand, if I take on those 5 million today, will it really make up for the difference that I own in this company? And once you did that math, you're going to find the right timing. Now, when to approach VCs is a little bit of a different question though, when to raise funds, right? So approaching usually means you start building a relationship. And typically you can never start too early, but there is such a thing as you need to focus on the right elements at the right point in time. So from my perspective, I'm happy to talk to you today, even if you don't even have a full product, but I want to see the journey. The more data points I can get, the more trust I have, right? So going back to trust, if you can tell me a year ago, I'm going to be there in a year and I can see that, I believe in it, you see? So there are more points in my mind that I can tie together and it makes sense. However, if you are still sort of figuring out the team, and you have so much shit going on, you probably don't want to waste your time just building relationships that might never be needed. So there's a bit of a trade-off on your end as well to think about, well, am I really ready now? Do I have materials ready? Do I have a cap table ready? Do I have a pitch deck ready? Don't speak to people just for the sake of speaking and building relationships, but also make a great first impression. So by the time you actually reach out, have at least a nice looking deck together and at least know your story. Have your numbers straight. So do a little bit of the work before you start reaching out, and it's going to be a lot better. I hope that answered the question.
Many thanks
what do
for
you think?
this. Yeah, definitely. Many thanks for this detailed answer to this complex question. And again, to add a few elements, if you look at the statistics at European level from Invest Europe and Avolta Partners, on average, bootstrapped companies, so not funded by VCs, but only by business angels or only by founders, they take 10 years to exit, whereas companies funded by VCs take 7 years. That means that VCs select companies that may exit faster, but faster, as Susie told, it's a marriage. It's a 7 to 8 years marriage. It's seldom a quick exit, and also it's an exit at a higher price, fortunately, because companies funded by VCs raise a median amount of 3.5 million euros, and they exit for a 24.5 million euros, which is exactly 7 times more the equity injected. And so, of course, there is a dilution, but the company is funded only bootstrapped, or only exit at 17 million euros. And so, again, of course, you are diluted, but you exit at a higher price. And so you have to accelerate, and VCs are definitely accelerators, and they select companies that may run faster. And so other questions.
Summary.
Yeah. A question from Legal Analytics. What about strategic partners, private investors, like companies, family offices, if they had invested in the early stage? And what that means, it would be a seed stage for family office, I don't know. And how do you cope with them? How do you survive? Do you like it? What about the shareholder agreement? Or do you simply say it's a deal breaker with if there is a corporate fund? Is it possible to play the venture capital game with these guys?
Good question. I think the key point here is to remember how much do they own. So if a corporate today, for example, owns more than 50-60% of the company, it can become really, really tricky. And you might have to reorganize the table a little bit, because actually in the early stages, what we want to see is that the founder is super incentivized. So we want the founder to own the large majority of the company in the early stages, because over time, as you know, the more money you might have to raise, the more dilution you have to suffer. So especially at the early stage, before we start coming in, we want you to have the large lion's share of the company. Now, with a couple of strategics, they can offer incredible access to their partners, their mentors, their network. And actually, we love it a lot. But the key is for them not to have too much right away, because it's going to impact the incentive of the founder a lot. So there's a bit of a trade-off here where you have to almost wiggle out what is the right percentage. We don't mind it. Actually, in fact, we co-invest quite a lot together with some of the strategics, also maybe some family offices. I think that they are usually a bit earlier stage. So you would see them mostly around angel seed stage, not at Series A anymore, unless they're really big ones. And I think it actually works out quite well in most cases. The few cases where it doesn't work out that well is usually around time horizon, because they can have a very different structure. Some funds have a 5-year life cycle, so they are a lot more under pressure. And as Etienne said, the outcomes, the acceleration needs to happen a lot quicker, whereas I guess a lot of the family offices tend to have a bit more of a 20-year horizon. So you can see how there could be a clash when it comes to selling, when it comes to next steps. So this is where things can get really tricky. The other piece is around how active are you on the board? I think a VC is typically incredibly active. Like, we would attend every board meeting. Whenever there's help required, we're here for you. At least, most of the funds probably would subscribe to that. And I guess a lot of the family office are a little bit more passive. Not all of them, but I feel like a lot of them are a bit more passive, because they just think about it as 20-year deployment and let's see what happens. Obviously, this is not true for every single one, just making it very clear, but I do believe that the general DNA has a bit of a different flair. So it's not always easy to combine a more active and a more passive without the passive one thinking that he's being sidetracked. So it just is not necessarily exactly always the same page. Whereas I think if we team up with another VC, we think alike. I mean, we have exactly the same pattern. We know exactly how we work. And it can be a bit smoother for the founder himself, who doesn't need to negotiate between parties that have very different interest levels. So comes down a little bit to where you see the upside, but also make sure that as a founder, you keep the large majority, regardless of whom you're having. Now, you mentioned as well private investors, family offices, and strategics. I think they all go in the same camp in this case. Yep. So there's a lot of collaboration between them, but also there can be frictions along the way, especially with strategics that could potentially use some of your knowledge for their own purposes. So you have to be very careful, for example, with information sharing. I'm not saying that's what they're there for, but it can happen as well that there might be some discrepancies.
That's what it should be. Why it should be a real corporate venture fund playing the venture capital game and not trying to block a deal. And when it comes to family offices, generally they are a bit more risk averse, and so they seldom intervene at seed stage before Susie. I think they more come for B stages, and they are right statistically, because growth capital on average has a better internal return rate on average. But of course, it's very dependent to these famous home runs, so big deals where you make a 1,000 money multiple or things like that. Some VCs are dreaming about. So another question of Summer, very interesting, because is it a one size fits all? But because of course you take a minority stake, but does a VC take a 10 to 30% stake, or is it at least whatever the amount raised, 20% in order to exert a certain influence? What's your opinion about that?
Yes, I think a lot of funds have a very specific target in their mind. So for example, for us, it would be 15. So I always want to get to at least a 15% minimum stake level. And if I can only get to 12, I'm going to have a really hard time with my partners. So it's really important that these levels are met. Now, obviously, we can negotiate on pricing, because that's the sort of second part of the equation, correct? So there is a certain level of negotiation power, but I do believe that a lot of the funds you might come across have something between 10 and 20. 30 feels like a ripoff. So if you're giving 30% away, it's either an incredible valuation and you really want to sell a lot, or it feels like too much. So 30, be careful. I think 10 to 20, that feels pretty correct. And then every round, obviously, this thing goes down, but it goes down along the curve. So that feels about right to me.
Okay, a question from Aditya. Is there a correlation between VC firms versus location? For instance, VCs from Silicon Valley, are they more or less inclined to invest than VC firms from New York, to invest perhaps in European companies? What about Sequoia Capital co-investing with you in a German startup?
Yeah, it's a good point. So I guess there is a sort of location element to it. Like if you think about Sequoia in particular, they just opened up a European office, which is the first time they've ever done this, right? So they used to have this old tradition of like, they want to only back founders that are 10-minute maximum foot walk away from the office. It was like the big mystery, right, about how they do deals and how they source like closeness, how they create strong bonds between people. And now I think they realize that there's like a big emerging wave in Europe where they can't miss out on. And obviously you can't walk in 10 minutes from their, San Francisco office to here. So I guess now they realize they have to open up an office, and they really create this sort of stronger bond in the European network as well. Now, there's a couple of international funds that can literally do whatever they want, and they can have 5 different offices across the world, and then they invest wherever they want. But I guess there's also other ones, especially a lot of the UK ones, that are a bit more local. So it depends a bit on the country and the size. So when you think about the US, it's a huge market. So they tend to have offices at least in 2, 3, 5 different locations across the country. And it might feel the same as in Europe. You have the same sort of reach, and you might have an office like Index in Geneva and one in London and one in Paris. So it really depends a bit on where the funds are. If you were, say, to expand from the UK to the US, typically the best thing is to find a European investor and a US one and let them team up and help you on both edges. Do you see what I mean? So you would want to, that's also why it's so important that you're clear on what exactly you're looking for. If you're telling me you really wanted to expand to the US and the round is 50 million, don't worry, I'm going to find you someone I want to work with, you hopefully going to like, and who can fill that gap and this sort of piece that is missing.
Okay, well, lots of questions, but we'll stop at 5 o'clock. And so another interesting question from Uma, what are the key requirements to establish a VC company? Let's say, Susie, if I wanted to create a seed fund and I'm a first timer, I know some of VCs, it took a lot of time. So how can you get some these famous LPs that will make you the gift of existence?
Well, I guess it's almost a chicken and egg game, right? Because without the funds, you're not going to make good investments. And without good investments, you're not going to attract good LPs. So I think there's a bit of personal profiling in this industry where it's super important that you sort of stand for something, that people know you, respect you. So you build a personal brand. If you think about a lot of people that have launched their own funds, they all came from different backgrounds, but most of them did come from another VC. So if you think about Alex Flomo, who used to be at Notion and now he set up his own fund. You know, these are people that have had experience. They know exactly how to do good deals. They have built up a little bit of a track record and then they sell it to a really interesting LP they met along the way. And they give them the first push. And so help them really set up the first round of the new fund. Now, it's not as easy as it might sound, to be honest. Setting up a fund is bloody hard. And I'm not going to lie to you. This is something, I mean, I don't know I'm ever going to dare to do it because it's really, really like, you know, it's tough, right? Between making sure you deliver the right returns, you build the right, it's basically building your own company and finding all the pieces around it and need to fall into place. But also your business is not a product that you create once and then you keep selling it, but it's finding always new, exciting ideas and always being on top of everything that's happening in the market and being able to really make sense of the world. So the product itself is really hard to keep it alive and just make sure that you're really pushing in the right direction. I guess a lot of the LPs today that people would target are people that are very institutionalized. So there is sort of a database of people you can almost go through and they're always willing to try new, exciting seed funds that are first timers. Like a couple of years ago was Hoxton, where people had no idea, you know, how they were going to do, but actually the first one was really well. And guess what? The second was super easy to raise. If the first one doesn't do well, the second one is going to be really hard. Sorry.
But if you are a first timer, you have to be tenacious, and you'd better partner with somebody who was already a general partner or a partner in this industry, because otherwise it will be difficult again to build trust. But this time not with entrepreneurs, but with LPs. So another question: if we go back to funding at seed stage, not at A stage, what if a company has a prototype and has no traction at this stage? So are there some exceptions that make you invest, Susie? So again, no product market fit because there is no traction, no audience, no sales, no recurring sales. What makes you make this leap of faith anyway?
Yes, I think here's the question.
And what valuation in this case?
Exactly, that's what I was trying to get in. I guess you can raise, if you're really inspirational leader, right? You can raise money without revenue, without products, without traction, without anything. There is great examples in Europe where people had nothing and raised a lot of money because they were so convincing and they just had the right sort of network. They got the right grip on things, so they can do that. If you don't look at how much dilution they suffered, it's huge. So there is again this trade-off where if you want to give me 80% of your company for 2 million, we can talk about that, right? Even without traction. But is it going to be a good deal for you? That's the key question you have to ask yourself. So without much traction, are you really going to get a really good deal? I would think not. And that being said, you know, traction can mean a lot of things to different people. Like for me, even just having 1 or 2 customers is traction, or maybe having an agreement with a partner is traction. So traction doesn't have to be revenue figures ticking up according to a chart. It can really just mean I already had 10 people apply to a position. Obviously, they might think that I'm building something interesting. So there can be a lot of different signals on traction, but what you really want to do is point them out. Otherwise, you're not going to get potentially the best deal you could.
Okay, Susie, I think there are tens of questions. I think we have to organize another conference because, well, thank you so much for this testimony. And thank you all. There were even additional questions from audience through YouTube because it wasn't, not sorry, because you are too good. That's the problem. And so again, well, I like hosting that kind of discussions because usually if you make a traditional course, there there is almost no question. You have nobody, you don't know if people are snoring behind their screens. And so definitely, I think it's a tricky issue. But again, the message is you have to go fast to play this VC game, and you have to be truthful. But of course, it also applies to the VCs, and because you have to check. It's a marriage, as you said. Yes. And so again, we throw it would only be a 1 hour conference. It is recorded, and so you can get back to the link. But again, thank you very much, Susie, for all your invaluable contribution. And we'll for sure do something even more focused because there seems to be a lot of interest. I'll analyze these questions, and we'll for sure host another conference if you like, of course.
Always right here.
and thank you, Adrien. Thank you, Cheryl. It's a pleasure to work with this HEC MSIE team because there is a lot to share, and I also recognize some names of existing participants. And again, Susie is member of our final jury, where entrepreneurs pitch in front of seasoned business angels and VCs, and they get feedbacks, always benevolent, and that's the name of the game. So this Red Thread project, where people pitch a real business plan in 5 minutes plus feedbacks. Thank you so much.
Thanks a lot, everyone, and have a lovely rest of the day.
Thanks,
Etienne. Thanks, team.
Thank you.
Thank
Bye-bye.
you. Bye.
Thank you.
Bye.
Goodbye.
Bye-bye.